People are asking why, with all the things the U.S. has been doing lately, the U.S. trade deficit hasn't meaningfully been coming down, nor has the U.S. in aggregate been meaningfully reindustrializing, although, of course, there's definitely bright spots in certain sectors. I'm going to predict right now that the U.S. is never going to fix its trade deficit, which means it's never going to see large scale reindustrialization until it does something about something that almost nobody is talking about. What I mean is the overvalued US dollar. Now, the reason for this is if you have an average tariff like the US currently has, maybe 14%, depends on how you calculate it. And if the US dollar is overvalued by 15 to 20%, which is the estimate I get from Coalition for a Prosperous America, you don't have a tariff on net. You either have nothing or you have a negative tariff, which is still making imports too cheap in the United States and American exports too expensive and hence uncompetitive abroad. Now, the problem is that you can't hack your way out of this problem just with more and more and more tariffs, which would also cause other problems. And the reason is that the price of a currency is set like anything else in a market economy by supply and demand. So when more foreigners want dollars to buy things that you have to pay for in dollars, it pushes the price of the currency up. And when fewer foreigners want dollars to buy things you pay for in dollars, the price of the currency goes down. And it works the same way when Americans are buying foreign goods abroad. Now, what this means is that if you don't deal with your currency problem, if you just let the dollar float, it means that anything you do to push the deficit down is going to mean that the U.S. is demanding less foreign currency to buy fewer foreign goods, right? Because that's what the deficit is. It's mean we are buying more foreign goods than foreigners are buying American goods. Okay, so when you push the deficit down, you're going to move the dollar proportionately up, which negates your solution to the problem, and you're right back where you started from. Now, there are people out there who will tell you, like at the Peterson Institute, people will tell you that this is a perfect one-to-one relationship and that no tariffs can ever do anything good on the trade deficit. I don't think that is true, which is a very extreme formulation of the position. If that were true, we wouldn't have deficits in the first place. But I do think that the offset from any remediation of the trade deficit that you do by way of tariffs is strong enough that the only way to get yourself all the way out of the trade deficit with tariffs would require pushing tariffs way up to absurd levels that actually would be inflationary in the United States, which thus far tariffs have not been inflationary and would result in the U.S. making at home all sorts of products that are really ridiculous to make here. So you're constrained on how much you can pull on the tariff lever to move the trade deficit down. And it also backfires, not completely, but to some extent. Now, what do you have to do to get the dollar down? Well, same logic as before. Why is the dollar pushed up? Well, the dollar is pushed up not just by foreigners demanding dollars to buy American exports, American corn, Boeing jetliners, you name it, but also to buy American financial assets, which are dollar denominated. So if you want to buy T-bills or shares in Microsoft or whatever, you have to demand dollars. And it's this demand for dollars for the sake of acquiring financial assets that's what's pushing the dollar up too high. The reason this happens is the U.S., unlike any other major country, suffers from a structurally excessive demand for its financial assets. That is, there are too many foreigners out there who want to park their investable capital in the U.S. Now, To some extent, this was for many years the result of deliberate policy by nations like China that were proactively having the government buy U.S. Treasury bills and things like that to help keep their currency down and keep their competitiveness up. That factor is still occasionally there, but it's no longer the most important factor. The most important factor is a purely secular private sector demand for too many dollar-denominated assets around the world. Now, the reason this happens is the U.S. has the world's largest, most sophisticated, most liquid, generally most profitable financial markets in the world. And if you need somewhere to park your money, you can't park it in Swiss francs. Switzerland is a tiny country with fewer people than Metro Chicago. You'd buy up all the Swiss francs in the world, the entire Swiss stock market, before lunch. So, limited number of places you can park your money, and the U.S. is the place that gets chosen. Now, to get the dollar down, what you do is you need to push back gently but firmly against this excess demand for American assets. And the way you do this is with something called a market access charge, or MAC. Okay, there was a bill in the Senate in 2019 called Baldwin-Hawley that would have implemented this. Didn't really go anywhere, but it's a bill that's been introduced in Congress. And what it does is it applies a small but variable tax on foreign purchases of U.S. financial assets, which means that the U.S. can, on an adjustable basis, make buying its financial assets sufficiently less attractive. We're not trying to make all foreigners go away. We're just trying to damp down this excess demand so that we can gently, over a period of maybe 5 years, lower the dollar by 15-20%, and that will help bring our trade back into balance. The suggestion Coalition for Prosperous America makes is this be added to the Federal Reserve as a fourth mandate. The Federal Reserve currently has a mandate for full employment, price stability, and moderate long-term interest rates. You add balanced trade to that would be one way to handle it. There are other ways you could organize it institutionally, Treasury Department. But anyway, this thing has been thought through. Now, one thing to remember is in the 19th century and during the Bretton Woods era after World War II, when the U.S. was not running chronic trade deficit, part of why this is the case is because exchange rates between currencies were fixed. They're not floating like they do today, where they just get bounced around by traders at computer screens in New York and London and so forth. And the reason they were fixed is in the 19th century, you had the gold standard. And then in Bretton Woods, you had a formal system of fixed exchange rates, which breaks down in 1971. And lo and behold, right after that is when the era of giant U.S. trade deficits begin. So anyway, as I said, I'm predicting right now that the U.S. will never solve its huge trade deficit, which means in turn it will never properly reindustrialize, which requires more output in the United States, either to satisfy domestic demand or to increase exports and satisfy foreign demand, until we fix the dollar.